Hello, I'm David Frazier, aka the Market Monk. Well, we had some more entertaining news today, or at least events, developments that were referred to as news by the media. They're really just stories, and that's generally what we get on these news outlets. And actually, a lot of these news outlets do refer to their the pieces that they do, interviews, comments, and so forth, as stories. And that's surely what they are, because rarely are they on facts or factors that matter or developments that matter regarding almost anything. They're just simply on what the media outlets think will get attention. I don't think they have much interest in actually informing people. They just want to sell you a story. So they did it again today on Friday, April 4th. Two of the big news stories today, which I'm going to cover very briefly. Then I'll get into what matters regarding the financial markets. But real quickly, on the coverage about the media today, one was an interview that I saw of New York State Attorney General, who said that he's now investigating these high-frequency trading firms and whether there are any illegal activities going on, and whether or not what they do is fair, and trying to find ways to make trading more fair. And I emphasize the word fair because I get such a laugh when I hear these people talking about fairness. I mean, come on, life is not fair. Nothing in life is fair. This guy supposedly has a problem with what he refers to the slow lane and the fast lane regarding the execution of orders when people decide to trade stocks. The slow lane he referred to as what the average investor is faced with, the lane of trading that person is in regarding the execution of his or her trades. And the fast lane has to do with high-frequency traders. And he said how this is so unfair that these high-frequency traders are able to be in the fast lane and to execute trades more quickly and have an unfair advantage. Well, I have a question I'm going to pose. So let me make sure I understand this Attorney General correctly. So let's say, for example, that I, David Frazier, decide to pay for a high-speed internet connection because I want the internet to move really quickly. And my neighbor doesn't want to pay extra money for that higher speed internet connection. And let's make it even ridiculous for the moment. Let's assume for the moment that person still has an actual dial-up internet connection rather than a broadband internet connection, because that person doesn't want to pay any extra money to get faster speed. So if that's the case, if I decide to execute a stock transaction through an online broker, well, I'm going to be able to get to my account much faster than my neighbor. I'm going to be able to buy or sell the same stock much faster than my neighbor because I have a faster connection. And I might get a better price, because this is assuming stocks are going to go up during the day, and that's not necessarily true. They might go down seconds or minutes after I buy the stock. But I might get a better price than my neighbor because my neighbor chose not to pay more money to get a faster connection. Well, so that's all that's really going on here. These high-frequency traders have invested huge sums of money to get information more quickly. Well, what's wrong with that? It's unfair. So let's see. If I get on in Los Angeles or many cities across the country, if I'm driving down the road and I have two more people in my car besides myself, then I'm able to get in the high-frequency vehicle lane and will probably be able to get somewhere quicker than someone, at least during business hours, than someone that's not in the high passenger vehicle lane. So is that unfair? I don't know and don't care. This is a bunch of nonsense. What I find interesting is these very people that now are making such an issue about high-frequency trading. Many of these people are governmental employees, and yet to this day, not one high up management person at a major commercial bank, investment bank, or brokerage firm has spent 1 day in jail, has paid any fines personally out of their own pocket, or has been required by legal authorities to submit payments to individuals that were hurt by the mortgage crisis. Even though studies have shown that many of these very people were well aware of the problems that were going on in the mortgage markets and the housing markets, at least in 2007, if not in 2006, and did nothing to resolve those issues. And in many ways, certain studies have shown that these people knew that there were misleadings going on. But we don't hear anything. But none of these people paid any fines or in jail. In other words, there's something that I would argue is a major issue regarding the financial markets. Nothing ever done about it. But now all of a sudden we're going to make a big deal about high-frequency trading. This is a distraction. It's nonsense. It has almost none, if any, and it probably has no effect whatsoever, no negative impact on the individual investors. It's a bunch of nonsense. It's a distraction. Stay away from it. It means nothing. It's a story. That's all it is. One more story, and then we'll get on some things that matter. And then I heard and read today about a congressperson from the state of Virginia who, in an interview on Thursday, said that members of Congress are underpaid. Members of Congress are underpaid. Well, members of Congress, I think the lowest base salary of any even freshman congressperson is $178,000 per year. So that's in the top 5% income bracket. In the top 5% of all personal incomes. That's the amount of money they're getting paid, but they're underpaid. And what I found even more interesting is these, we often hear of Congress people claim that they serve the public, that they wanted to be in public service. Well, wait a minute. If you're serving the public, if your purpose for campaigning to get into Congress is to serve the public, well, I would argue, why should you be paid anything? So this person actually is claiming that he and other members of Congress are underpaid. Bunch of nonsense. So let's get on to what matters now. Well, the NASDAQ Composite Index fell sharply today on Friday, April 4th, and a lot was made about that by the general media. Big drop in stock prices. Stocks. Boy, this is a problem. This is a bad day on Wall Street. Well, what was behind that drop? Here's what was almost entirely responsible for the big drop in the NASDAQ Composite Index, and that is numerous stocks of companies that have no earnings, that have never made a profit, and looks as if they may not make a profit for several years, if ever, but that are priced at some of these stocks $150, $200, over $200. Stocks such as Netflix. Netflix actually, I just don't recall. I don't recall whether or not they made a profit last year or not. But I do know on a recent analysis I did of the company that even if they did, that it was very easy for me to ascertain that the financial market participants are substantially overvaluing the likely future earnings of the company. Twitter never made a profit. I don't know if it ever will make a profit. Tesla, over $200 a share, hasn't made a profit. I don't know if it ever will make a profit. Athena Healthcare. Let's see, what are some others? Palo Alto Networks is another one. So numerous stocks of companies that are have been trading at over $100, if not over $200, never had any earnings, and might not ever have any earnings. Well, of course there was going to be a day when these stocks would take a big hit, when people that hold their stocks would decide, hey, maybe I should get out of this stock. I made some money here. I don't know, there's really no justification for the stock being as high as it is. I think I'm going to get out of it. And so we had a big sell-off. But even with that sell-off, if we The NASDAQ composite, by the way, if it hasn't already said so, was down 2.4% today because of a big drop in those storage stocks of companies that don't have any earnings and might not ever have any earnings. The NASDAQ was only down 0.7% for the week as compared to last Friday's close. So that is Friday a week ago, not today. And the S&P 500 index and the Dow Jones Industrial Average were all up modestly today versus a week ago. And we're all actually had sold off very modestly today versus yesterday, but we're still up versus a week ago. And so this is not a big deal. Of course, the NASDAQ took a hit, and it's probably going to continue to take a hit because these storage stocks are still well overpriced. But what's more important is that the latest readings on numerous economic indicators for both the United States as well as many other regions of the world continued to increase last month. I mean, I'll give you a few examples. Manufacturing activity here in the United States was up during March for the 10th consecutive month. In Japan, up during March for the 13th consecutive month. Up in the Eurozone for the 9th consecutive month, and up in Brazil for the 4th consecutive month during March. Construction spending in the United States was up during March for the 32nd consecutive month. Durable goods orders rose last month. I could go on and on and on, but I just, don't want to make this video too long. I like to keep these between 5 and 10 minutes, and I'm guessing this one's going to be a little over that. What's important here is, the reason I'm bringing this up, is these economic series, manufacturing activity, orders for durable goods, construction spending, have been very reliable leading economic indicators over the past 50 years, meaning when the readings on those indicators increase, economic activity and the overall pace of economic growth tends to increase for at least several months following increases on the readings on those indicators, and stock prices in general tend to trend higher for at least several months following increases in the readings on those indicators. So, we have some positives developments going on in the overall economy. Lastly, the U.S. Department of Labor reported this morning that the number of jobs that were created in the United States during February and March on a seasonally adjusted basis, that the number of jobs created during February and March were up substantially as compared to the number of jobs that were created during December of last year and January of this year. And so the employment picture has improved somewhat. And my research indicates that the employment situation in the United States, as well as in Europe, is going to continue to improve during the months ahead. So I expect stock prices in general to continue to trend higher, and of course we're going to have pullbacks and declines in stocks that are way overpriced. But in my opinion, if you're not fully invested, you should take advantage of these pullbacks and get invested. So that's all for today. I'll speak with you again next Monday. Thank you for listening.